Welcome. My name is Craig Wichner with Farmland LP. Thank you for joining us to fireside chat to talk about the impacts of shifting trade and labor policy on U.S. agriculture. I am thrilled to be here with Dr. Bruce Sherrick, who has been a good friend and contact for a long time, about a decade or more. Bruce, because I get to control the slides here, I get to call you what I want. And so I listed your title as Bruce Sherrick, PhD, professor, overachiever, and gentleman. So,
I'd like you to comment that you can write my eulogy as well. Then that's a little nicer than I usually get introduced.
Bruce is really, to me, the best agricultural economist and farmland expert. He is the professor of economics at the University of Illinois and runs the TIAA Center for Farmland Research. That was, I think, probably endowed just for you.
It,
Um,
it, we have that great fortune at U of I. That's true. Yeah.
That's great. Also, really, and I really don't think Bruce sleeps much at all. And we've talked about it because he does so many amazing things on the like credit risk assessment and modeling of agricultural financial institutions. Expert in crop insurance. You manage institutional reporting or for the NCREEF farmland data set, which is the NCREEF is the organization that all major private entities who own farmland report together so they can create a benchmark for themselves about how they're doing in agriculture. They can really compare themselves basically against their peers because there's really not a lot of good public data available for this stuff. I used to be on the board of Farmer Mac, which is essentially the government-sponsored enterprise for financing farmland, similar to Fannie Mae and Freddie Mac, and a number of things. Has absolutely extraordinary background, and glad to have you here, Bruce. Um,
Glad to be here. We always have a great time whenever we meet each other at conferences. We always have something fun to talk about, and the 5 minute little hello on the sidebars when we're coming into or out of a room always turns into a good hour. So.
Always a lot of fun. And just a quick overview for me. I'm the founder and managing partner of Farmland LP. We buy conventional farmland, convert it to organic regenerative agriculture as an investment fund. Been doing this for 15 years, have about $300 million under management, and have a lot of fun with that, both buying farmland and managing farmland in the US. And this is really a interesting time in agriculture. And Bruce, I wanted to bring you in to talk about what the impact is of trade and labor policy, which is really in flux right now on agriculture, and particularly from the investor perspective. How should investors be thinking about this stuff? Just that kind of superficial view, there's a lot of noise in the headlines and hard to really translate that to what's actually happening on the ground. I actually want to show three quick slides as background because this could potentially be a dry topic, but people need to it's so impactful on people's lives. And it's so connected to people's lives, both on a personal level and an economic level. And so I actually wanted to start by sharing the top food and beverage imports in every state. And so, for example, so this slide shows what the biggest import is. So, for example, if you're in California, the number one imported crop is avocados. If you're in Washington State, it's coffee. If you're in Illinois, interestingly enough, do you know what it would be, Bruce?
Um, you know, I wish it weren't beer, perhaps, but I think I have heard this stat a few times, and maybe what's going on in the world is why we're drinking a little bit more in the middle of the country right now.
It is exactly beer, and there's a lot of beef and other products, but these things are really impactful. If you look at the dollar figure of U.S. imports of what we import, about $7.5 billion a year in beer, $6.6 billion a year in coffee, and really the U.S. doesn't grow any coffee. That's actually one of our investors is a coffee broker in the U.S. and I roast coffee, so he joined. He gives me beans, and he says that his son is now traveling around the world, and instead of importing the best beans into the U.S. because of tariffs, they're brokering them to other countries. So Indonesia is now buying my favorite Ethiopian coffee and other things. So there are some interesting trends and concerning trends personally for me as a Ethiopian coffee drinker. Um, another quick slide here. A fifth of the U.S. food supply is imported, and the U.S. average household spends about 14% of their annual budget on food. So it's a chunk of the budget. The issues for me here are that the amount of imports is increasing significantly. So where we used to import in 2008 only 35% of the fruits and nuts, today we're importing around 60% of the fruits and nuts. And that's similar trend in other crops. The organic market is actually a little bit different. $71 billion a year spent on organic food, but that's almost entirely grown in the US and consumed in the US. So less than 1% of organic food is exported, and only 7% of the organic market is imported. That's primarily high value fruits and vegetables. Uh, and then lastly, Bruce, and this I'll start turning it over to you, is the U.S. agricultural trade balance has really declined over the past 10 years quite substantially from about 10 years ago being over $40 billion a year in our favor to now being $40 billion, a little over $40 billion negative for us.
Mhm.
So we went really from being a ag exporting country to over the past 10 years being very dependent on imports, and that is growing. The amount of imports really is growing quite steeply. If you can see this curve, that green line. And so this, Bruce, kind of sets the context for me, or the relevance for let's start with trade
Mhm.
here and tariffs. What do you see as kind of what's happening today? Where are we today? What's
Right.
going on? And what are you concerned about, and where do you see it going?
Yeah, great to start with the softball questions, huh? But let's jump. No, the some a little additional context to some of the data that you've shown. Historically, we had exported a big share of our corn and soybeans. Prior to that, wheat. Of course, the world demand for coarse grains is still going to result in the U.S. exporting corn for a really long time, and soybeans, but to a little bit lesser extent. After the first round of tariffs 6 years ago, we had kind of lost some of that market and won't get all of that back. But the net trade balance, exactly as you said, for agriculture is negative, and this is important because for the rest of the economy, we have the opposite sign, of course. Um, for certain parts of the ag sector. And let me put a little bit more detail behind that. we really like blueberries all 12 months of the year, and we really like strawberries all 12 months of the year. And we found out that horticultural crops you should grow on both sides of the equator, so you get two growing seasons per year for genetic modifications and for breeding and so on. So the composition of that net that we have now is largely in fruits and vegetables and horticultural products, and the exports are still largely coarse grains. If you back up, kind of zoom out on the economy a little bit further, we import something on the order of 11 to 13% of the US GDP per year. That's depending on the year, of course, for lots of reasons, and we export about 9 to 11. So the difference is a couple percent of the GDP. That's still a big number, and both sides of that trade equation have been growing because we've been growing more exports, growing more imports, and relying more on trade because it turns out that comparative advantage is a real thing. And around the world, you should do things where it's cheapest in terms of total resource draw to do things. So you could dig up iron ore out of the bottom of Lake Superior. It turns out that's probably not the best place to mine iron ore, but you could. It's easier to mine it in parts of the world where the surface is, where ore is closer to the surface of the planet, for example. Well, that point that you were making, that we have switched, is very true. And it makes it really hard to reverse. So one of the sort of unexamined premises of the headlines that we see flying around everywhere, trade deficits or surpluses are neither good nor bad. They're just the consequence of markets. So if you go from a situation where you had fully isolated production and consumption systems, you would find out that trade deficits would actually increase your standard of living. You would find out that trade surpluses also increase your standard of living. Whenever you can exchange what you have a relative advantage in producing with someone else who has, for example, excess labor or excess tropical soils or excess something in the world where it's easier to grow. That's one of those that makes this point very well. That slide is a great one. Both sides have an increase in the standard of living. The other somewhat unexamined premise, if you will, is this idea that manufacturing is somehow an essential part of an economy. For the last 100 years or so around the world, the less you rely on your manufacturing sector, the higher your standard of living in the country. So you stop producing heavy goods and start moving towards services and things with more intellectual components to them, intellectual property and scientific items and medicine and research and so on. And so again, a lot of what we see in headlines is based on, I think, sort of popularizable arguments that don't have as much weight behind them if you take them apart. But yeah, this one is very clear and it's been growing through time. And Mexico and Canada in particular have been increasingly important to the US and should be increasingly important in the future. China, you see the little break kind of in the area around 2020. Just a comment about what happened when we had our first round of tariffs. China started buying a lot more of the soybeans from Brazil, and the US had to start exporting the soybeans to places Brazil used to export to. Now, remember, prior to that, each of those relationships, those shipping channels, if you will, were dependent on the least cost total so that you could take from places you can grow, which are very limited on the earth, actually, places you can grow a lot of coarse grains, and then taking them to places where people are also very fixed in terms of the planet's location. Once you give that up, you don't really get it back. It's not something that you can just turn ships around and put them on the opposite side from the Atlantic to the Pacific and renegotiate all the trade routes again. So Brazil has kind of taken over on the soybean market, and that's a real thing. But again, zooming out further than just the agricultural case, it's true for other industries as well. So you hear, we need to make iPhones in the US. Well, we certainly don't. Making an iPhone in the US might cost $20,000 a phone. And there's a report that I had seen that says somewhere between 30 and 40 countries are involved in the manufacturing and IP for a single iPhone. And so you can't, it's not as simple as the arguments might suggest that you could just rearrange trade and change where things are produced and where they're consumed. Moreover, it's not a positive thing if you were to. So I don't know if that's responsive to the question, a little bit of a ramble. Um, but again, the balance of trade has been developing countries rely more on trade in both directions. And suppose you exported and imported 50% of your GDP and had no trade balance or a trade deficit or surplus. Or suppose you exported exactly zero and had no difference between imports or exports. You're clearly better off when you can trade and take advantage of what other people can do better than you can. One of the original slides that we may have talked about in terms of the changing population of the planet, what really made this one right there, it took most of human history for our population to reach 1 billion and just over 200 years to reach 8 billion. The difference is that's when we started doing intentional agriculture. It was not just simply eating only what you could capture or find or the hunter-gatherer kind of idea. The original comparative advantage, where can you grow things? Well, you can grow things where there's soil and water and sunlight, and you can't grow things where there aren't. And where do you consume things? Where people live, and those aren't identical locations. And so some version of that original trade was growing more corn than you could eat and trading it for animal skins or something. So that has been a concept in economics. And 200 and some years ago, Adam Smith wrote about it, and we understood this to be true, and it's still true, despite whatever you might read in a headline.
And a lot of what people used to do was they had to grow food for storage to get them through the winter. And now we really do have this global supply chain where you're able to get fresh fruits and vegetables all year long. They're not
Yeah,
growing next to you.
yeah,
And that hasn't changed. What's changed is these incredible transportation networks that we have that allow us, like this is a slide that you have as well,
yeah.
which shows the ag trade in the U.S. To throughout the world, where we are getting our food from around the world, and we're also exporting around the world as well.
Yes, absolutely. That's a great slide. The width of the arrow gives you a magnitude. The direction from purple to blue or blue to purple tells you whether you're importing or exporting, and you can see the major sources of, beginning and ending. And what's dangerous is losing one of those routes to a different place. And I don't mean just from the U.S. perspective. Um, Anytime you add more complicated transportation, think about it like you're replumbing your house, and you take all of your faucets and you run the tubes outside around your house for 3 times before you connect them back to the water supply. You don't need to add all that extra plumbing to get things from point A to point B in its most efficient form. And that's what essentially tariffs do. They put some wedges in the system, in the place, and create much more expensive consumption. And if you want to get to the more technical parts of it, given that a consumer has to both reallocate and pay more for something with or without a tariff, there's no possibility. It's a mathematical impossibility to collect more in tariffs than the consumers lose in purchasing power in total. And one of the common misconceptions is, well, just charge the corporations or just make the producers absorb part of it. Well, corporations are just a pass-through entity. Your 401k may own them, or mine may as well. But somebody still lost that value. If the cheapest way to subsidize an industry is to literally directly subsidize an industry and not run it through the charade of a tariff. Just if you want to make washers and dryers in the US, then just pay. to make washers and dryers in the US don't put tariffs on ones that come from another part. So,
And you generally you tax things you want less of. It's kind of the economic policy is if you want something less, you tax it, like the carbon tax, for example. People want to tax carbon so that we have less carbon. Okay, well, do we want to tax imported food? Uh, do we want less avocados? Do we want less coffee? Do we want less off-season fruits and vegetables? Uh,
yes, and the complement of that, every time you said less, you also have to say at a higher price. Do you want less that are also more expensive? And no, I don't. And I don't know of any professional economists who think this is a good idea. And we've tried it all the way back to Smoot-Hawley and before that, in fact. And we've, developed two very good international systems, GATT, General Agreement on Trade and Tariffs, and WTO, the World Trade Organization. And one of the things I think people also sometimes forget, again, this is going to geek out a little bit, is that pre-Bretton Woods and then post-Bretton Woods, where we sort of forced some currencies to be tied together and then decided they could float, we had a very different mechanism to denominate or count the numeraire, because everything could just simply be created, converted to a dollar, and then spun back out to whatever the local currency was. Well, one of the things that's important to recognize now is something called the trilemma, and that is exchange rates, trade, and monetary aggregates, which determine interest rates, are all interconnected. And this is really strong empirical evidence behind this. So you can't just say, I'm going to put tariffs on without accounting for the impact on your foreign exchange rates, for example. And the loss in one, it's a great big balloon. You push on one side, something else has to give. And so strong dollar, weak dollar, do you want one or the other? Well, it depends if you're exporting or importing, but you can't have both. And you can't, partially say, well, when we're importing, we want a really strong dollar, and when we're exporting, we want a really weak dollar. It doesn't work that way. So I think this idea that you're going to somehow re-equilibrate or punish somebody by shooting yourself in the foot, that, again, you hear my not even subtle criticisms of the whole idea of tariffs to begin with. But I also think the other point, when you ask in the way you ask, I don't think any of this is going to be very permanent, because it seems to all be a show so far. And eventually markets do win. It's like trying to keep water uphill by sweeping it all the time. Eventually markets are going to be stronger, and eventually trade reorganizes itself. You put a tariff on China, you sew the last button on in Vietnam, and now shirts come from Vietnam. And I use that example because it's kind of true. All the clothing that you now see made in Vietnam generally started in China and had some last operation done. So those kinds of reroutings, because there are hundreds of millions of possibilities for rerouting, not just 185 countries worth with some, chart of stated accounts. So I think that is important to recognize, is that whatever we're doing is very disruptive, won't outlast market incentives, and in the meantime is counterproductive to standards of living.
I'm pulling up another slide here,
And
which looks at the different trade surpluses that we have by crop. Because really, when you start to dig down a little bit, and none of this stuff is political. You're a professor of economics. This is not a poli-sci uh, session. This is really just, hey, looking at like the fundamental economics, and as investors, how should we be thinking about what the impacts are going to be, because they're different in a lot of ways depending on the crop. Like corn and soy in the Midwest, their export markets, they're dependent. Like I think 60% of soybeans are exported, and those export markets are really being harmed. On the organic agriculture side, we grow, it's made in America, sold in America for the vast majority of the crops. And if there's a trade barrier about high value organic fruits and vegetables coming in, that's actually benefits the organic market. So there are these winners and losers here. How should we be thinking about, like when you think about kind of the ag sector as a whole, how do you think about winners and losers here?
So it's another great question, and we can point to some specific sectors and identify whether they win or lose. And those are somewhat obvious, but I think the question is what determines whether something wins or loses is a little bit more complicated. The world is a couple of immutable starting points, or at least if nothing else, I'll state them as though they're axiomatic, that truth unless proven otherwise. The world's demand for calories is going to go up a lot. And it's going to go up for two reasons. One, the world's population is still expanding, and that's a fairly predictable thing. This is a great map of that as well. This is the one that says when you do grow something, you capture a calorie at the sunlight. Do you put it into fuel? Those are the rich places of the world. Or do you put it into food? Those are the poorer places of the world. The western corner of Africa is going to be home to a very large share of the world's population by 2100. There's most estimates say 5 of the top 10 most populous countries will be in Western Africa. So the places you can grow and the places you consume depend on population, but even more importantly, on standard of living. So if you eat a calorie from a plant, you get a first generation 1 cycle calorie back from the sun. If you put it through a chicken, it may take about 3 calories to get a calorie back for human consumption. Pigs about 9 perhaps, cattle about 13 or 15 if you count dairy and so on. So that's a lot. And what happens is as the country gets richer, its standards of living go up, and importantly, switch to more rich proteins, which take a lot more calories. And so the multiplication of calories is not just a longevity in a population, but more driven by standard of living. As standards of living increase, the quantity of things that you eat is very predictable. With this chart, if you look at it through time, you almost don't even need a date on the study. You start moving toward more meat, among other things, as you get richer, and at some point you top out the amount of meat you want to consume, and you start eating higher quality meat. The world is substituting and growing its demand for pork and chicken really rapidly, beef a little less rapidly, but there you go. By 2050, we're going to eat a ton of chickens, and we're going to add a ton of pork, and beef is going to go up. But in terms of total caloric change in the world, the others still dominate. You see missing from that are things like crickets and proteins that substitute for meat are really still very expensive in terms of energy use to produce. So those aren't on the graph either. But if you start with that, now you can answer the question you asked. What is going to be benefited? Well, the things you have to move to feed animals are probably long-term winners. So soybeans are still important, and corn is still really important. And for the rest of the world, wheat is still an important feed grain, not just food grain. So what about fruits and nuts and apples and cherries and things that don't have as long of a shelf life, perhaps, as stored grain? Those are a lot more complicated to move. You can't process them as well and shrink the container in which you move them. So they're a little bit more sensitive to impacts of trade. We've overplanted some of the fruits and nuts. In the few places on the planet you can grow pistachios, there aren't that many good places to grow pistachios. And water is pretty critical and becoming more expensive in certain areas where tree nuts in particular are produced. So I think you can sort of point at least where some of the major friction points are. But that doesn't mean that the successful ones aren't still more. The final part of this really complicated puzzle is growing less doesn't make them a less attractive investment. Right sizing them still means that permanent crops, if you said magically we're going to grow exactly the amount we can consume on a world basis of both permanent crops and annual crops, the expected return on the permanent crops would exceed the expected return on row crops because of the additional risk of the production company and the risk of part of the assets being above ground. But right now we're in a position of oversupply of certain parts of that. And each time you put on something that affects trade, the higher valued things are impacted first. And so that's kind of the waypoints on why you would expect it's number two yellow corn. It's number two yellow corn. Really large non-pearl almonds are really valuable until they're not. You grow one too many of them, and then it's paste. And so I think that sort of immutability kind of feature of the demand for some things helps explain it. The other thing that I want to say is that, and then we have a couple of great questions too, maybe we should turn to a little, but the agricultural policy in this country and in the world in particular has gone toward more support for agricultural production. In the US, our joke on our farm doc team is ad hoc payments have become the new standing program. And we chatted earlier today, and the comment I was making about no matter what the question is, right now the ag committees seem to say the answer is, well, we have to pay more to farmers. And during Trump 1, we had MFP payments and other forms of support that were meant to offset the amount of lost revenue that happened because of tariffs. And again, it's a form of subsidy. It's a form of political sponsorship we can choose. Not good for the economy in total, but farmers who get paid more if they don't produce something than if they do might still vote for that policy. So right now, the sentiment from DC is to extend farm programs, increase reference prices, add subsidy to crop insurance, do things that are positive in terms of production of the majority of coarse grains in the middle of the country. Not so much for permanent crops or cherries or wine grapes or things that don't have standing commodity programs behind them.
And for some of the viewers, quick definition between permanent crops versus annual crops.
Oh, yes. Sorry. I assume that everything that's in my mind starts out in everyone else's as well. So corn, soybeans, things you plant once a year, and you can choose to plant something differently next year. Those are the annual crops. Permanent crops would be things on trees or vines or things that have multi-year lifespans and for which part of the asset value is dependent on health and vigor of that actual thing that's producing things. Corn, you have a failure one year, next year, completely unaffected. It doesn't affect the soil, or soybeans the same sort of way. So the permanent crops have a lot more risk above the ground, and annual crops tend to be valued almost exclusively based on the value of the ground, regardless of what was planted there.
That's great. Yeah, when we are buying farmland, we generally talk about farmland being the aggregate of three components: sunshine, dirt, and water. So sunshine is the growing environment, dirt is the quality of the soil, and water is both physical access to the water and legal ownership over the water. And those are kind of the big factors that drive the value of farmland, both today
Right.
and in the future. You have flexibility about where you grow some crops, but we don't grow coffee in the United States. Maybe Hawaii.
Yeah, we're not going to grow bananas or vanilla or lots of things in the US. It just doesn't make sense. And we're also, those are just the realities. I heard someone once make the point, and it's really important. The US can be divided into the regions that have too much water and too little water, and it's about 50-50. And so crop insurance, which is a really notable form of government support, insures against too wet of a spring or too little rain in the summer or wet harvest season or so on. And that's really largely in parts of the country that are subject to flooding in the springtime. That's where a lot of the payments are. Or once you get further south in West Texas, where there's likelihood of a drought or consequence of problems with irrigation. And so that water resource argument is true, but in terms of the world's access to water, the middle of the US and parts of California are uniquely good. And then the the Columbia River system has a remarkable remarkable capacity to help support agricultural production, and you can't really replicate those in other parts of the world very well at all. So,
Yeah. The U.S. is very well positioned from an agricultural production standpoint. One of our investors asking a question, Wendy Richards, is saying that she's hearkening back a little bit. Even if it is temporary, you said we will never get back the
yeah,
Chinese soybean market taken from Brazil.
right.
So even the temporary disruption is very real and with an impact on the dollar. Can you clarify that?
Yeah, both of them with an example, perhaps. If I said, suppose your income was $100,000 a year, but I just stop it for 6 months, and then I give it back to you starting in 6 months and go, oh, we're fine. It's all the same again, right? A lot of this is a flow effect, right? So you don't get back what was lost, but importantly, the investment of that difference also has an impact on your long-term productivity. If you spent none of that and you had always been investing it and say at 5%, then you have 5% more capacity to consume every year. And if you gapped it, you don't get that back. More importantly, with soybeans in particular, Brazil has invested a lot in its infrastructure, transportation infrastructure up the Amazon and out to the coast and even across the mountain ranges. And so you're getting to the point that once you help finance that development, you don't get back the difference in transportation costs the U.S. used to enjoy because of being able to get the rail systems and going out toward the West Coast or getting on the Mississippi River and going out toward the port, or even the northern St. Lawrence Seaway. So that's part of that. Yes, even if it's temporary, you don't get those market shares back. You've helped another, that 6 months I took away my income and I'm going to give it to you and you invested it all. You have that advantage in the addition forever. The dollar example on currency values too. Suppose using numbers that are somewhat real. I happened to be teaching a class when a senior level class. So these are really good students, and we were working on exchange rates, and we have some great tools to just monitor down to every 10 seconds we could look at the entire world's complex of exchange rates. And when the dollar to euro went from 108 to 110, and then 110 to 106, and 106 back to 109, the students were just calculating the total impact on purchasing power of the US from having it go up from 106 to 110 as a gap, for example. And it was a little over $6 trillion if you were to redenominate the world's trade in dollars. And so the impact is very real. On that 11%, you can think of it as being entirely purchased by dollars and sold in dollars as a rough analog to what would happen to the value. And when you sell it for dollars that become less valuable, you have to sell more of it to get that same value, or you just have less income. And so the readjustment in the value of the dollar against the trading partner currencies is a very real thing as well. And generally, a strong dollar is, for importing things, that's what you want. And generally, we're a net importer. So again, flipping it around on the elements for agriculture that we export the most of, you get the opposite effects. If we're buying blueberries from the Southern Hemisphere, I'm all in on Driscoll's sweetest batch. I mean, these are great. And we didn't have those 10 years ago. And if they're just $5 a pint or $6 a pint, I'm still probably going to buy them. But that was a dollar taken out of my value of purchasing power because of essentially a change in the currency rates.
So we full disclosure, we didn't pay Bruce to say this, but we actually grow organic Swedish batch
Didn't know that.
for
I
Driscoll
truly didn't know that. No.
in the U.S. So
Yeah.
thanks.
No,
Thanks.
the Driscoll control of genetics for strawberries and blueberries is nothing short of astounding as well. But speaking of that too, just while we're on it, the ability to grow more with less inputs is another major, spectacular impact of U.S. agriculture and around the world. Moving 88 day corn and 90-day corn and 100-day corn up into the Dakotas and into Canada. I was at a wonderful conference last week in Toronto with Canadian agricultural interests, and the increased production with less inputs, less fertilizer, less pesticides, and moving toward a less intense agricultural system. Whether we talk about words like organic or regenerative or sustainable or resilient or the label du jour, we are substituting at least safer inputs relative to older style chemistry in particular, and are growing things at a rate that can keep up with population growth. This is a great thing. The productivity increases are incredible. So,
Yeah, and first, a little bit of an aside. I want to encourage anyone with questions, do chat those in. We have people watching for those. And back to the question on the organics. One of the interesting things that happened, we buy farmland in basically large chunks. We at least 50 to 100 million dollars worth of farmland in one tight geographic area. So we really leverage the economies of scale in great growing areas. One of the things that we factor in are what they have to be areas that we can grow organic well and we plan ahead making sure that there's enough compost available. There's compost facilities available to provide the fertility that we need. And when the Ukraine war started, for example, natural gas supplies were impacted. Use natural gas to make synthetic fertilizer, ammonia and ammonia products. And the price of that imported fertilizer tripled over that time. Our cost for compost went basically from $100 a ton to $110 a ton, and then $120 a ton. So
yeah,
really had a very stable input pricing across those periods, even while there was much more volatility in the market. So there are interesting advantages there.
yeah. The impact of the Ukraine war in terms of world flows on fertilizer were astounding. It was an incredible natural experiment because a lot of the northern hemisphere gets its potash from Canada, for example, and a lot of the southern hemisphere got its potash from Ukraine. And so again, not just ammonia, not just nitrogen, but a rearrangement of where you had to ship a lot of things played out very, very quickly to determine that was a positive thing for the northern hemisphere and for the U.S. in particular in a relative sense, but a bad thing for Brazil in a relative sense in terms of where the cost of that one particular input was coming from. Around the country, getting organic fertility from Arkansas, chicken litter or something up to North Dakota is a complicated and expensive transportation. So being able to find your inputs and locating or co-locating someplace close to another generator, a little bit more of that circular economy kind of idea, does make a lot of sense. And so you can't just, you can't grow corn in Alaska very well, and you can't grow potatoes in certain parts of the world that are, not suitable like they might be in Alaska. So locations have their own comparative advantages too.
Can I go back to something about the dollar, the
Yeah.
change in value of the dollar? And this is where I love talking to you because I don't really know the answer to this. Um, the So the dollar has been negatively impacted by the policy changes that have been happening. So the value of a dollar is going down uh, globally. I think that's partially an impact due to the uh, federal deficit and the debt issues and the trade kind of going away from the U.S. As an investor, that dollar going down in value, what do you see as the big impacts there? How should we be thinking about that?
Oh gosh, that's a great question. And if you'll all sign up for my ACE 444 class next year, we have about a 3-week module on that. And so I think it's a hard thing to compress into a quippy little response, but I can make some dents in that question. Um, if the US prints a bunch of money, which we did twice recently, most recently during the pandemic, the rough idea of a quantity theory of money holds. You make each dollar worth less if you print too many of them. We were trying to print enough dollars to offset the amount of production that was stopped during the pandemic when, for public health reasons, people were asked to not produce. We clearly overfilled that bucket. The predictability of that was inflation. Inflation is really good for asset values that are highly fixed. So farmland appreciated relative to other assets in the economy as a result of that overprinting of money. Again, fairly superficial, but the rough theory actually of theory of money, the quantity theory of money is actually pretty good approximation for this. Well, other countries can do the same thing too. And if you don't change the total relative production, and all you do is scale both currencies by the same amount, then the exchange rates will stay the same. If the US gets really productive relative to the rest of the world, we'll just use US versus RAL. If you said US is going to produce 10% more than anything else, you can either say the currency is now worth that 10% more in terms of buying stuff from everybody else on the same quantity, or you can say the quantity you could buy of something that both countries wanted, the proverbial Big Mac index. It takes less dollars to do that than it did of the other currency. So I think of exchange rates as being driven by two things. One, relative interest rates, and interest rates are determined largely by quantity of money and productivity. So if you started at a 1-to-1, but the US had a 5% interest rate and Europe had a 10% interest rate, you would gain 5% on that because the euro would go up to 110, the dollar would go up to 105, and that 105 over 110 is now cheaper, the stronger dollar, as opposed to the 100 over 100. Again, I know the terminology that trips students up is stronger means it takes less of. So the number of dollar, the thing you talk about, the dollar went from 110 to 106. That's a strengthening. It sounds backwards. But that is a really good way of thinking about it. And the assets that are most exposed to that are the ones that turn over fastest. Assets that don't absorb a lot of that value increase. And on a world basis, the dollar was still pretty strong. The US economy survived COVID. The US system of production was still growing pretty quickly compared to the rest of the world. You have to take China out of the equation because the currency doesn't float. So it's hard to talk about the yuan or RMB relative to dollars with any certainty. But the dollar also grew because productivity increases in the US were higher than in other parts of the world. You can either get a pay raise or you can produce more with the same amount of inputs. Both are the same to you as a consumer. Took less of your time to produce the same amount, or you got more dollars per unit of time. It feels the same. That traded for the other currency, think of an economy at a time, tells you what foreign exchange rates do. And the forecasting of those going forward is really accurately done just by taking, it's called the Dornbush model, but you just take today's rates and multiply them by forward currency rates or foreign interest rates. So that was again, little tiny dots that even if you, it's kind of like an Andy Warhol picture. If you back up far enough, it begins to make sense. Those little pieces are pretty complicated, and I apologize to everybody who's saying, yeah, he oversimplified that by a factor of 20.
Well,
But I think
I'll,
it's a good start.
I'll try oversimplifying it even further. Um, uh, so as, assume that the dollar is going to keep going down. I'm not saying that's what's going to happen, but just a declining dollar benefits a foreign investor who invested in the US. Let's see, no, it declines. Anyway, but it will a domestic producer will should see more sales because their crop uh, is going to have a lower price on it domestic internationally. Other foreigner non-US customers are going to be able to buy more of that basically for the same amount of money. Is that fair? And so, yeah, help me with that.
So without charts, it's hard to make sure that we're both talking about the same thing. When you said like the dollar goes down, that means it went, for example, from 106 to 110, right? That's a decline in the dollar. And it's hard to do without like numbers in front of us. But let's try it this way. Let's suppose that the Canadian dollar and US dollar just bounced between 1 to 1. And right now it's like 128 or 127 or something like that. So we'll say it bounces between 1 to 1 and 1.5 to 1. And so when you can buy 1.5 Canadian dollars for a dollar, I'm going to start with a decidedly domestic perspective. I want to buy a bunch of those. And then when it comes back to 1 to 1, I want to sell a bunch of those. And then when it goes back up, I want to buy a bunch. So you can think of that from either perspective. And instead of dollars, you can just simply substitute the word land. And that makes a pretty clean way of thinking about it. The problem is it's hard to predict directional foreign exchange numbers. It's substituting one hard problem for another. I do think, though, the dollar, got its first real scare when the bond market said, hey, there might be some credit risk in dollars if we really did do these Trump proposed tariffs, and that led to the 90-day pause. I had a colleague come into my office that morning and said, just checking, I think the bond market's a load-bearing wall for the economy, right? So yeah, the bond market is in fact a load-bearing wall. The price of dollars is just the interest rate, and it's held up pretty well, despite all the turmoil. It's held up pretty well for the last 3 months.
Great. Um, let's transition over to labor on this, the other topic that we're going to talk about. And I'm putting up this slide here because there's actually something kind of embedded in this that relates to labor. We see that the number one export here is grains and oilseed. And the ones that we're importing more are food products, fruits, tree nuts, etc. And there's the labor component of this, I think, is actually really important in that if you just actually look at labor costs, Mexico to the versus the U.S. Um, Labor costs in California, for example, minimum wage is now about $20 per hour for the workers. That same worker in Mexico gets $15 a day on there. So an incredible labor arbitrage and labor differential between that. And so the implications in the U.S. for U.S. agricultural production is that we really steer towards things that are low labor input, and that can be really mechanized in a big way. When we started investing in farmland 15 years ago, we had farmers growing asparagus on our land, which has to be picked every day by hand laborers. That's now 10 years ago, basically, they stopped growing asparagus at any kind of scale in the U.S. So labor becomes kind of a very important factor in terms of what we grow, and those trends go off into the future.
Absolutely.
And now we're even about 40%. What they say is 40% of agricultural labor is immigrant or even non-legal in the U.S.
Great. That's a great way of teeing it up. That's true for everything, though. So agriculture is easy to identify because, yes, hand-picked tree nuts and or not tree nuts, hand-picked produce and other, melons and things you have to move a vine back to find a cucumber. The places where labor is cheaper is where you would expect to grow that. Well, places where it's cheaper to assemble a car or an iPhone or sew on buttons is also the same sort of thing. You're just importing cheaper labor when you do that. You're exporting things that are harder to produce someplace else, like corn and soybeans, or you're exporting intellectual products, or you're exporting financial services, which is a really big part of the US economy now. So, right, and there can be moral implications, and people will have positions about how labor is used in other parts of the world, but markets work, and so you can. It's difficult to impose your own standards on somebody in Honduras who wants to make $21 a day compared to their alternative of making 15. And so, again, these are issues that have other dimensions than just the pure price, I recognize, but every time you have an import, some version of that labor argument you just made applied, even if it was an intellectual product like a highly technical chip from Taiwan, or whether it was the most basic element like a vanilla bean, or whether it was intellectual property embedded in licensing to do something inside an iPhone, or whether it was a movie we exported from the US because people still like US movies. All of those things just literally represent what you just said. An oversupply of labor makes labor cheap. That's where you should use the labor until there's not an oversupply anymore. So it's positive for the entire system. Everyone's standard of living goes up.
And we probably won't go into the general differential between the taxation of labor in the US versus capital. That's a longer discussion. The US does tax labor much higher than it taxes capital as well. And so what that does is it steers more capital in the US towards assets, more asset heavy or intellectual property investments as well. Basically, kind of leading to the areas where there's kind of the greater investment return opportunities in the U.S. Kind of thinking about labor, thinking about tariffs, and the overall dynamics that you've talked about as well, increasing population, increasing nutrient density. It does, fundamentally good farmland is beneficial. It's a very durable asset. But things like ag tech as well are opportunities. What do you see? And what are your thoughts around kind of from the investment perspective?
Gosh, this is another one of those that I have a really fun couple-hour presentation on, honestly. It's the things that influence an asset's value are largely interest rates, inflation, and income, right? And so you can think about tying all those together and the differential taxation and taxation of consumption versus income and the taxation of durable investment. All of those things influence the relative prices. But in the end, an individual has a standard of living that I like to use as my numeraire for everything. And so that's a combination of both your direct income and whatever share of the stock of productive resources that are, somehow generating why you can trade an hour of your labor for something, whether that's more or less in a different country. So agriculture has some very unique features. One, agricultural returns tend to be positively correlated with inflation. Again, this is Adam Smith, Ricardo, others noted that the most fixed factors of production capture the residual claims of anything when you're done paying for all the other factors, including labor. It's very true, and it's been true, and it will be true, and it'll stay very, very true for a very long period of time. So positive correlation with inflation is a really cool feature if you have something like long duration liabilities on the other side. So why should pension funds own farmland? Because it matches really well and it helps eliminate some of the exposure to shocks and inflation. Number two, interest rates. Agriculture is very underlevered, only about 13% leverage at the long-term asset side of the balance sheet, much higher on the operating side and much higher at the short term. But the interest impact is not nearly the spread, the credit spread on farmland, for example, is very small compared to the rest of the economy. To shorten that 1 hour presentation to the most salient conclusion, what you get when you buy farmland is a very stable credit spread. So if you think of the entire world as being like a 10-year treasury rate plus spread for risk and spread for term, farmland gets a bargain on that. So that one's really important. And then income, long-term expected income is very, very positive for agriculture because of the long-term thesis for caloric demand. And the more of it we put into gas tanks, the higher the value. The more of it we put into animals, the higher the value. The more we take out of production to build houses, the higher the value. So why would an investor want a long duration, uh, inflation protecting asset that has really good reactions to interest rates in terms of you get a little extra. Your alpha is absolutely immutably positive compared to other things. You just get a big positive alpha for a low beta, and that the long-term expectations are really strong. Well, it's you do, but you have to have enough of it to influence the rest of your portfolio. That's the hard thing because it turns over so slowly and in such strange chunks. You just said you like to buy 50 to 100 million at a time. Those don't happen all that often. They're very rare transactions, even 50s or 20 million or 10 million or 5 million, 2 million doesn't happen that often. Farmland turns over at 1.5 to 2% a year. So it's a great thesis, but it's hard to buy. It's really hard to dispose. And we've created um, a factor inside the portfolio that has all these positive attributes. And by the way, most shockingly, has outperformed equities most of the entire period since the 1970s. Not necessarily NASDAQ, but a broadly held portfolio. So yes, it's a really positive portfolio asset. Really, really positive portfolio asset. Hard to buy, hard to sell, hard to manage. That's perhaps why it has generated superior returns to most other things. The consequence, and again, not you weren't leading me to this. I'll say this whether you ask this question or the opposite question. Ag tech tends to be ag adjacent things tend to be something people look at because it's hard to buy real assets, hard to buy farmland. And we kind of went through this explosion in interest and then it tapered off. And now it's kind of coming back into favor again as the adjacent asset or a way to get exposure to the asset class. And I think that's in the long run going to be true. I don't know that it's quite materialized yet. Been a few big winners, but you mentioned the labor thing. Well, robotic harvesting of grapes and many of the vegetable crops has already started to happen. Or blackberries, you can mechanically harvest blackberries, and it's shockingly about as good as humans, a lot quicker and cheaper. And blueberries likewise, and shaking trees and so on. That substitution for what would have been more expensive labor is an ag tech kind of innovation. See and spray technologies, astounding reduction in input use, astounding accuracy, variable rate planting and variable placement of inputs. And the things that are happening, and we're just going to keep seeing them. On the labor thing too, some of the hard ones to replace though, so think about where most immigrant labor might have its greatest impact, probably in dairy and in construction trades. And it's really hard to build a robot to shimmy out on a truss and nail it in place while you're building, a high top roof. And it's really difficult to learn enough about milking to really replace the person who's moving the milking machine around. So I think those are risks, and that's a place where reductions in labor force, just before I forget that thought, will probably spur more investment in ag tech, things where there's a great deal of sensitivity, or where it's really hard to replace that version of labor because it's heavily dependent on immigrant work right now, but it's kind of specialized too. And so it's hard to you're not going to find the 18-year-old who wants to go intern at a dairy farm for $14 an hour. So
We definitely, I think of what's happening in ag tech now as kind of the second wave of the internet. For example, like when we transitioned from Yahoo to Google.
mhm.
And I do think that ag tech went through its kind of dreamer phase, and then there was a little bit of a crash in the sector. But the companies that we're seeing now, it's very real, very applicable
Yep.
technology that's pretty darn mature. We use blueberry harvesters that replace 100 hand harvesters with about 4 people on a blueberry machine.
Mhm.
And these are higher skilled people. These are the kinds of things that I think are really happening across the sector, in addition to improvements like the improvements in crop genetics,
Incredible.
through breeding, is absolutely amazing. When you go to the store and you're buying food, it really is better food nowadays.
Absolutely.
Um, uh,
So on that one, I have a way of kind of asking the question back in terms of the pace. Um, I have one talk that I give sometimes that I start by asking people to take out their phone and put it face down on the table in front of them. And you get a little grumbling, like, he doesn't want us texting, he wants us to what. You get a little of that grumbling. And then the next thing I say is take out your camera and place it on the table. Take out your calendar and place it on the table. Take out the device you listen to music on and place it on the table. And after you go through the 11 items that I like to start with, I say, can anyone tell me when you went from 11 to 10, 10 to 9, 9 to 8, 8 to 7, 7 to 6, 6 to 5, 4, 3, 2? Why we call that a phone in the first place is because that's the one thing we never changed using it for, but we kept adding all the other elements to it. Agtech is a bit that too. You go into a modern, $1 million combine now, or a tractor while you're planting with both auto steer and down arms that change how deep and how compacted the seed bed is around the seed based on the speed that you're driving, the residue in the field, the moisture, and the type of soil that you're in, crossed by the amount of remaining fertility from last year, based on an imagery that took out how much green matter there was. That's a little different than when I was growing up and looking for matching planter plates to put in my 4-row corn planter to plant sweet corn, hopefully without grinding up the kernels. So I don't know when each of those things happened. I don't know when each of the advances that mattered happened, but the quality, incredible quality, blueberries, blackberries, strawberries, all the fresh fruits that we just take for granted now being available everywhere all the time. Table grapes, incredible improvements. And the production costs of those have gone down. Secretary Vilsack has a great quote. I won't get it quite right, but we produce twice as much as we did 20 years ago with less than 2/3 of the inputs in terms of inputs to grow the same quantity of output. But it's also better. And we have ability to store it better and move it around to consumers better. We kind of take it for granted. The 14% of income that you cited is both at home and away from home food
right.
expenditure. It's fun to go into a group and ask what they think how much money they think they spend at a grocery store in a year,
Hmm.
and ask the percentage of your income you spend on food. And
Hmm.
here's the great paradox: the less you know about how much you spend on food, the more likely you are to spend more on food, not as a percent of your income, but as a total amount. So the more we drive the cost of food down in society, the more profitable it is to produce that same amount of food.
Hmm.
It feels like a paradox, but it's absolutely not. The lower the fraction, the higher quality, the more you're willing to spend for better, the the margins go up. And so this is again one of the things that I think is a great goal. My North Star is cheap, safe food for the world, right? You don't have to be a US citizen if I think people shouldn't be hungry. So if you can drive the costs down, that's a really good thing. If people then choose what they want to consume, they can choose organic, Driscoll's sweetest batch, my local farmer's market, something I imported from Korea with Bibigo or something on the label. What fresh fish, farmed the ability for me to use markets to signal what I want is the greatest advantage possible. And here's to tie back into one of the things we were talking about earlier. That another thing that's happened in agriculture is this attribute of production is now part of the demand system. I want to know if my grain was grown sustainably or organic, or there's a lot of label competition and a lot of label confusion. The Butterfly Project, a frack-free gas you can buy from your natural gas company. But this idea that people do care about how something was produced, not just the cost, because there's no differentiation in the product. Once you have an attribute that's being demanded, that translates all the way back to the system of production and begins to differentiate how you produce things. That's going to keep going in the direction it's been going. I don't know how fast. As the world gets richer, we want more information about how our food is produced, not just the cheapest calorie. More variety in that, more fresh, perhaps more things that are complicated to get all the time. You'll pay more to get it more of the time, which is, again, why I assume I'm going to have blueberries in the grocery store for the rest of my life all the time. When I was a kid, it was a summer feature, right? So I think those are the other elements of this increased set of production attributes in demand, and agriculture being part of the solution instead of just being pointed out as the problem. That's a great thing. Again, the original solar collector is still a plant. And if you want to capture carbon, first generation is capture it and use it. Second generation is capture it and store it. 50 generations is oil in the ground, from 1,000 years ago. Anything you can do to make it easier for people to replace the thing that they're buying with something that had a carbon or a sustainability component, because that's something they care about for all kinds of reasons, the more valuable that feature of production is.
The people have to eat. And the thing that allows these food prices to either stay the same or even go down is, to me, and a fundamental driver of this is economies of scale. And you do get technology. It requires a lot of investment capital in there. And what you do see is that the farms that are producing the most food are the larger farms, and larger farms continue to grow. I'm not saying that's a good thing societally or not, but those economies of scale are so important. You were talking about buying $100 million worth of farmland at a time. Just to be clear, we aggregate properties in one tight
Yeah.
area. To add up to that, our average purchase is around $30 million
Yeah.
For those farms. But there's a lot of farmland in the U.S., about $3.8 trillion or more.
Just over 4 now total.
Just over 4, which
Yeah.
is about the same as all of the apartment buildings in the U.S. or all of the office buildings in the U.S. And 40% of farmland is leased as well, a little over 40%. And so you actually have basically absentee landlords and a lot of farmer tenants basically who don't have an incentive to invest capital in that land. They'll invest in their equipment, but not necessarily take that land through the organic conversion. So what we're driving basically acquiring that farmland at a large enough scale in a tight geographic area, and that way, we can then invest in that technology at scale and have relationships with Driscoll's and drive down
Yeah.
the prices at the very highest quality. But it's with the tariffs, with the labor issues, it's with the higher interest rates. When I look around, I see it's actually a challenging environment for the average farmer to do these investments, to scale up. I think that's why the pace of change in farmland in food is basically slow compared to the pace of change of your iPhone, right?
Yeah, there's lots of different facets on that gem right there. So the USDA numbers for number of farms says there are about 2 million farms left in the US. And of course, that's a misnomer. Only about 1 million grow enough to even count. So start with roughly 1 million real farms, and I think the best indicator of a minimum commercially viable scale of a farm is however many acres the second largest combine deer makes can get over in a year. And it turns out to be a pretty good measure. Number two, in the middle of the country, 60% is rented. And 40 nationwide, but a little less easy to do with, an apple orchard or something than a row crop area. And is that good or bad? Well, we have a policy system in the US that favors smaller production units, which are less efficient. Think of that 1 million farms. And it's even less than that if you go to a farm that's of scale that a family can survive on the income. But call it 1 million for now, call it 330 million people in the US, take account of the amount we export in terms of calories. So instead of one farm being 330 people, it's now like 410 or so people. And then depending on how you want to account for ethanol and fuel, assume there's an offset on energy roughly from ethanol. One farm still has to produce enough for 410 to 450 people. That feels like a lot to me. What's the scale of that? It's not what we envision as a farm being this romanticized notion of the farm I grew up on, a few hundred acres with, a couple tractors, chickens and cows and big garden. That's not commercially viable in the long run. Is it good or bad? I don't know. Do they invest in the productivity of the soil? I think so. I think the case that I have in mind is if you want the highest return, you also want it in the form of capital gains. And so there's a statement from, we think, George Morrow, after whom the Morrow plots of Illinois are named, that says something like this. There are two sources of return to farmland. One, the annual income from the production of the crops, and the second, the gain in value of the underlying asset. And it ends with the latter will be the greater through time. So 2/3 of your return to farmland comes in appreciation. It's very tax efficient that way. Really good to have a big chunk of farmland. Again, why should pension funds own $1 billion each? Because it's really tax efficient and you get more of it in non-tax return. You get a capital appreciation instead. Is that good or bad? I don't know. I really don't know. But I think markets sort it out. The flip side I always use as my example, I don't think that shoes should all be made in factories owned by the shoemaker. I think that's incredibly inefficient. But we don't seem to care about who owns Nike stock. We do care about who owns farmland. And so there's something fundamentally different that we've surfaced in that very comment. And production units do need to be large, and scale does matter. It really, really does matter. And if your North Star is cheap food, you probably want big units of production. If your North Star is locally produced food, you probably want small units of production. If your North Star is fill in the blank, you want fill in the blank based on how those production systems align with your preferences. So I think your points are spot on, and I think they're going to keep getting larger. And that doesn't mean there's not also a role for smaller production units, more specialized somethings. I think the ownership equals operator romantic notion we had for 100 years is going away, though. I think that's a truism. I'm very pro farm. I grew up on farm. I want to have some farmland. I think farmland's critical. I don't think I'm going to ever have a commercially viable scale holding of farmland. I don't think that's a problem, though. I think that's okay.
Yeah. Our one of the interesting things about our business model is that we really saw that the best way to manage farmland from a healthy soil biology perspective was to have much more crop diversity and more crop rotations on there. And so if you start from that, then it becomes natural to not try to have one farmer grow four different crops and try to grow them all and rotate them, but actually have a large enough land base so that you can bring in farmers who can each specialize in one crop or two crops, and lease the land and rotate around according to the ideal, healthy soil biology practices. And so that's been very effective. And we lease out we convert the land to organic. We manage that farmland. We only farm about a third of it ourselves, and we lease out two-thirds. And a lot of our farmers are very successful organic farmers who then expand their business on leased land.
Mhm.
So that way they can double or triple their production without having to go through debt and be all that asset intensive. Um,
Yeah, I mean, with some investment friends that had exposed, I had an organic farm for a while, and it's a different skill set. It's not the same. You don't just pick off the neighbor and say, "Hey, you want to add another couple hundred acres to your production system?" It's a really different management system. Um, I think that notion applies in lots of different ways, though. Cover crops are viewed in some areas as highly desirable because, in a sense, they're a third rotating crop. In certain places, though, they're not useful because they create more problems in the spring or too expensive in terms of water or whatever. But this idea of healthy practice, good practice, productivity increases that are increasing through time and managing. I've observed, and people don't always believe me when I say this. A lot of the institutional owners are so motivated to stay out of the headlines that they're incredibly careful about their production practices and hold their farmers to a really high standard in terms of things that could have a detrimental environmental impact. Secondly, if you were, for example, an investment fund and you said, I can either get $400 of cash rent or $400 of improvement to that land, I'm going to let them put in tile. I'm going to pick that $400 of improvement. Why? The farmer is paying for something that makes the land more productive, and I'm not paying income tax on something. I'm converting income to a capital gain. And so I think that is increasingly the model people use. And I think this understanding water management and buffer strips and um, things that impact how nutrients move around in the soil is getting a lot of attention. More careful applications in the spring, things like that. I don't think we're ever going to go back to this. What some people would prescribe is we need to rotate livestock and we need to do this and that. The 28 million acres or so of Illinois farmland are not suitable to rotate animal agriculture through. And it's not suitable for growing lower quality or lower valued crops. So you're going to see intense agriculture with primarily corn and soybean rotations. Farmers are getting really good at things like residue management, though, and tillage management and cover crop sophistication at a level that never occurred before. And so I remain optimistic that we're improving at a rate that's consistent with everybody's return-seeking capital motivations. And to the extent they are long-term, which farmland is, you mostly make good investments, in my opinion.
So let's steer the tractor into the barn on the final
I
approach
like
here.
that.
I'll ask you one question and then any closing thoughts that you have
Sure.
from one of our viewers. If the current pattern of policy volatility with tariffs, labor rules, and regulatory shifts continue, what does the next 3 to 5 years look like for U.S. farmland? Who adapts and who gets squeezed? Good question.
Oh gosh. Next 3 to 5 years is what made that question complicated.
Yes.
Um, the economist joke is if you give a number, don't give a date. If you give a date, don't give a number. And if you happen to be right, don't act surprised. Um, in the long term, I think I'm very bullish on agriculture in the long term. In the next 3 to 5 years, I think we're going to subsidize our way out of it for most of the middle of the country. And I find that to be problematic. I'm not in favor of that particular approach. It's very expensive to the rest of the economy, and it's very expensive to the long-term competitive nature. Um, Before Secretary Rollins was even confirmed, she was telling people if there's impacts from Trump tariffs, we'll pay you as the farmer. And the current Ag Committee is very focused on increasing payments and very much increased subsidies and so on. So in the next 3 to 5 years, I think places where you get these event risk things that are hard to replace, So if you ended up, wherever we happen to be exporting a particular variety of apple, and we have a spat with that country for a period of time, that's a loser. I think a winner is probably the most typical, traditional, middle of the country agricultural producer who probably does have a pretty safe bet that if there's a major disruption in, say, soybean demand, that there will be major checks from USDA to make that up. So it's a pretty simple and simplistic answer for 3 to 5 years. I think in the long run, though, productive technologies win. Things that produce more with less costs, and costs are a rough proxy for all the things we care about. Environmental costs are included in that. Those are the winners long term. I think investing in appropriate trade relationships is critical. So to the extent, one of the examples we always talk about in my classes are how much of John Deere's revenue comes from overseas? How much of John Deere's production happens outside of the country? Where do you assemble tractors? Where do you cast things? And how would you interpret the headlines if it were a U.S. only company versus an internationally active country? And it's difficult to disentangle that. So the companies that are in a good position to answer the question instead of what you produce, the answer is where should we produce it? Because we have the ability to do that. I think those are the winners. Short term, 3 to 5 years, as we're I expect 5 to 10 years, we're going to be re-engaged in a full-on trade is good, battling for relationships with collections of bilateral and multilateral trade agreements again. I think WTO should become more aggressive and more relevant in the long run. And that will determine the winners in the future by market cases rather than by government actions. And that favors anybody who's a very productive and efficient producer.
Yeah, I'll add that US-based production and consumption, crops that are within the US are the most insulated, I think, from the current trade markets. US consumers are still going to eat on that and don't have to worry about trade issues. And then on the technology side, technology that reduces labor or increases the quality of crops or the manageability of crops, like imagery to forecast yields, for
Yeah.
example, the cameras that go down, for example, and count every blueberry, every apple, every cherry, and can quality assess them while they're still on the plant. There's some really amazing technology out there.
I was born way too young. I love watching some of these things. I absolutely agree with you. The technology for simple, how you tether and shape an apple tree now and how you reflect light up so that you turn all the right parts red at the same time. All the things you just described are but the tip of another set of icebergs that we haven't even contemplated yet.
Yeah. The hardware of the technology is amazing. The software has advanced so much. And now with the addition of AI, machine learning and AI, it's the next 3 years are really going to be quite extraordinary on the ag tech side. So with that, Bruce, any last wrap-up thoughts on this?
No, thanks for involving me in this. It's always fun to have a conversation. It's a little harder over Zoom than when we run into each other at a conference, but I really appreciate this and really enjoy this conversation. Thanks.
Bruce, absolutely extraordinary talking with you. Like always, it's such a pleasure. Look forward to talking with you again further and look forward to seeing you in the near future.
Thanks
Thanks,
a lot.
everyone. Thanks, everyone, for joining us. This is Craig Wichner and Bruce Sherrick talking about agriculture. And if you have any questions, do please email in. We're glad to follow up with you. Thank you
Thank
so
you.
much. Thank you,
Thank you.
Bruce.